Okay, so with that, it is 4:30. We're going to get started. And yeah, we just got a question. And yes, this is being recorded. We will post it on YouTube. We'll post it on Minyanville.com, and you can also download the slides if you'd like. Just a bit about Sean. He authors Minyanville's Tech Strat Report. He's been trading and researching tech stocks for over 20 years. So he is the go-to guy whenever you want to know about tech. He knows countless number of companies, everything from the cloud to PCs to smartphones to stuff we don't even know about. So, Sean, thank you for being here with us.
You bet. Is this our third or fourth one of these? I can't remember now.
I think this is number 3.
Okay,
so,
well, good.
And we're going to make it the best one so far. So, you know, we were having a brief conversation offline about how the hottest stocks in the market are in PCs, and I believe it was Gardner just said we've had 5 straight quarters of declining PC sales, which is a record. Yet Microsoft, Hewlett-Packard, the hard drive stocks are all ripping this year. Now, what do you make of this?
That's right. Well, I mean, part of it, I think there's 3 things. One, you know, a lot of what's done the best this year are the names that were, frankly, did the worst last year. So I think it's a natural catch-up play. I mean, they left Hewlett-Packard, left it for dead. There's a lot of value in that business, and there's a lot of assets in that business and tons of talent. So that's sort of a natural one. Microsoft, I've kind of been both right and wrong on. I mean, I've said all along that the stock has a ton of value. And as far as the PC food chain, what's really interesting is the hard drive disk makers. They're in a situation where they're basically in oligopoly status. So even in a declining industry, if there's very few people that they have a lot of pricing power in a market that's still okay, they can still make a lot of money, and that's exactly what's happened for them. Now, Google, they're in their own uber bullish world, and that's been my favorite name for a couple of years. But yeah, I mean, really, what some of the hottest stocks last year are cold this year, and some of the very worst stocks last year are hot this year. And really, the PC food chain was one of the worst places last year. But you know, so here's where kind of when I put this together. Aside from Google, I still think Google is going to do very well over the next 4 to 6 quarters, if not a lot longer. I put a piece on it not too long ago, well, a couple years ago, that I thought the stock would go to 3,000, and I fully believed that then, and I believe it now. I'm not super excited about Google in front of this quarter. But I do think once they start selling the Moto X Nexus, they could do really well. So then moving on to the other part, I think some of the stocks that have been the worst performers in the first half of this year are kind of where people should start looking. So whether it's like Apple or VMware, Facebook's kind of been hot and cold, but anything that is of very high quality, good valuation, still has a chance to grow, and just has not participated in this, near 20% NASDAQ run, could probably have a chance to do fairly well, especially if they basically just meet expectations in the next quarter or 2.
Okay, since we had Facebook on the screen, I'll take the first question from the audience. Facebook is a stock that a lot of people seem to be saying lately, particularly in the tech blogosphere, that Facebook isn't cool anymore. They're not as relevant as they used to be. They're heading the way of MySpace. I mean, do you place any stock in that kind of belief?
I don't place any stock that they're heading to MySpace at all. Again, some of the metrics are fairly well known. I mean, maybe some preteens and some teenagers and some college kids don't like Facebook as much as they used to, and that's the age group and the demographic that launched the platform. Here's the funny thing. There's 3 facts, though, that are pretty much indisputable. And my thesis on both Google and Facebook is predicated on pretty much one thing. In video advertising and in ROI, so return on investment for the advertisers, there is no other player except Google and Facebook. So Yahoo had okay results, and the stock is up a fair amount today. Yahoo's not even on the page when it comes to ROI from an advertising perspective. So Facebook's actually number 1. So if you want to run a big advertising campaign from like the perspective of a Coca-Cola or a GM or somebody like that, or a Tesla, you get the most advertising bang for your buck on Facebook advertising. Google's basically number 2. And if there were to be a number 3, it would probably be Apple, but Apple's yet to really get in the game. So it's basically, if you're going to do an internet marketing campaign, you pretty much have Google and Facebook, and there isn't much else. So longer term, I mean, remember how long people basically hated Google. I mean, I've been writing about how great Google was for 2 or 3 years. It was a very frustrating stock for about 3 to 6 quarters, and it's finally kind of unleashed itself in the last 2 or 3 quarters. I think Facebook could do something quite similarly. I don't like Facebook as much as Google long term, but again, pretty much until Facebook goes back to that IPO price of between 38 and 45 bucks, that's kind of where I think it should go. And then somewhere between that price, they really would have to start kind of proving that their growth is not declining. But again, if you look at the hard numbers, the growth is pretty good. It's hard to find a company with that much revenues or that big a revenue base that's growing faster. It's sort of the same story that Google had, you know, a year or 2 ago.
Okay, so we are going to pull back a bit and kind of look at the big picture with tech. So,
yep.
So why don't you quickly go through? I mean, what's the bull case for tech? Like, what's the appeal?
Yeah, I always like to have kind of a bull bear case long term. So what I see happening is that, you know, the train that hits you is the one that you don't see coming up with the one that you see coming. I mean, the rest of the world keeps talking about what's the next black swan event and what's the next market crash and so on and so on and so on. And I've written volumes on Minyanville the last 4 years of why the market is going to keep going up, and pretty much any major correction should certainly be bought. So what I see happening is the Fed has probably stayed too low for too long. There's probably going to be more inflation in the future than people expect. The companies have basically squeezed almost everything they can out of cost cutting and firing people and laying people off. So for the companies to keep performing and companies to keep beating the competition, they're probably going to need to do, not probably, they will need to have a technology reinvestment cycle. And they're probably going to need to have sort of an employee talent reinvestment cycle. So, you know, we could have rising wages. That would be the last thing to kick in. But the bottom line is, in a rising inflation world, which I expect, which is very contrary, one of the places that you can easily fight that is through IT and technology investment. So the bull case long term is sort of, don't think about the late 90s tech bubble, but think about sort of the 1989 to 1996-97 tech market, where you had a relative decade of underperformance in technology, and then what you had is you had almost a decade of technology investment. So everything from the finance space to the commodity space to the big industrial companies all sort of embraced all these new technologies. Now, on the opposite side, you always have to worry about, you know, macro events, a currency war issue. You know, anything can give us a 4, 5, 6, 10% correction. And, you know, you still can have black swan events that kind of come out of nowhere. But from a long-term sort of macro, sort of why invest in tech long-term perspective, especially for the next 5 to 10 years, I think we're going to be in a situation where the companies have just sort of squeezed the orange as much as they can, and now they're going to have to find places to invest in to make their business grow faster.
Okay, so that is a perfect introduction to our next slide, where we have some of the important themes Sean focuses on. And one that I'd love to pick your brain on it is government spending. I mean, I think we've seen a few companies, possibly Oracle, talking about how government spending has been, you know, hitting them. Now,
yeah.
Do you think that's going to come back?
Yeah, I mean, well, but so again, I just laugh when I watch CNBC sometimes and talk about people and why GDP numbers are the way they are. I think I've been pretty right and pretty clear on this. I mean, you basically have companies doing well, a lot of GDP being sort of developed from human capital, from entrepreneurs, and from companies, and you basically have a negative GDP offset from government. So basically, 2 years ago, it was states were in massive austerity. So all the states had to cut budgets. State spending is basically flat and probably going to go up now. And then large governments. So everything from basically the sovereign governments of the world have basically had sort of forced austerity program for the last 2 years, or you could almost say since 2008. And we're just at the point where they just don't have to do that as much anymore. Now, I'm not saying government spending is going to go from wherever it is to the negative side to start growing 7 or 8 or 9 or 10%. But any increment, if it just goes from negative to positive, that's a huge kicker. I mean, like just one company in the loan, Cisco Systems. If government spending just starts upticking from downticking, Cisco's earnings growth probably picks up, 200 or 300 basis points just on that alone. So yeah, I actually think it's going to increase. It almost has to. And sort of the age of government austerity is at least getting reduced, if not ending. So really, if you go out and look at any of the leading economists, the ones that do have sort of outlier growth forecasts for like 14, 15, a lot of that is predicated on government spending picking up.
Oh, okay. So why don't we talk about memory? You mentioned DRAM and NAND as the next railroads. We talked about this offline, and I didn't get it at first. So why don't you explain to people what you mean when you call them the next railroads?
Yeah, so we're seeing SanDisk with a really good report, and I mean SanDisk has had 2 or 3 really good reports in a long time. Now for DRAM, that's really more of a Micron story, and I'm kind of mad at myself. I wasn't on Micron in a bigger way earlier, but so you have the railroads. So basically in the late 90s, early 2000s, once you got down to where you had 2 or 3 rail companies that basically own the rail lines in America, all of a sudden they had really good pricing power and they started making a ton of money. So it's not like the amount of goods shipped over rails, increases 10 or 15 or 20% a year. It's pretty flat. But what basically happens is once you got down to an oligopoly status, which means a small number of operators basically have a monopoly, the companies have pricing power. Now we have seen this exact thing in tech. It's called the hard drive disk space. So you all probably can go look at a chart of Seagate or Western Dig, WDC, and STX. These companies did the exact same thing. You had way too many hard drive makers. You got down to basically 2 or 3 names, and once you got down to 2 or 3 names, they have just made an obscene amount of money. In fact, the worst trade I never did, I had Western Digital lined up like 2 or 3 times about a year to 2 years ago and never pulled the trigger. But Micron could really be a huge beneficiary of this. And again, they're basically down to 2 or 3 players globally, and they all know what they need to do. And another example of this would be like OPEC. OPEC kind of knows as long as they don't pump way too much oil, they have pricing power. So for the DRAM makers, as long as they don't bring on way too much capacity, they have pricing power. Again, it's not going to be a straight up line, but I think again, if you look at Micron and you look at stock chart of Western Digital or Seagate, Micron could end up looking a lot like that. So that's kind of my thesis there. I do want to point out like 100G. So what I mean by 100G is that's 100 gigabit Ethernet networking. So there's basically one key player. I have been on this name for years, and it's done really well a couple times. It's doing really well again. Is Ciena. So again, all the carriers globally basically have to upgrade their networks. And there's no reason to upgrade to a 40 gig or something. I mean, they're basically going with the best technology available, and that's 100 gig. And there's a few other players, but Ciena is sort of the most pure play on the 100 gig space. Infinera INFN is another 100 gig player. But we don't need to talk about all these, but those are 2 good investable themes there.
Okay, so on this 100G topic, do you think we could, a lot of people talk about big data, typically is an enterprise story, but with all the data people are consuming, on the consumer side, do you think we get to a point where the internet's just going to break? We get, really, kind of similar to power grid.
Yeah.
In a heat wave. Do you think we get to some point where, globally, on a massive scale, all these characters have to upgrade because they can't just handle it. They just can't handle data.
Again, it usually doesn't hurt me for too long, but one of my weaknesses, and I'm getting better at it, is identifying an investable theme too early. So that's, I would have said 2 years ago that the global ISPs were so strained, their networks were so strained that they were basically at a breaking point. But the bottom line is, if they invest in 100G and if they keep adding bandwidth, no, they won't break. But if you get to a point where the only investment that's really materially occurred in the global networks has all been Band-Aid based. There hasn't been a major investment cycle. There was a little blip of one from 2009 and 2010. It was about a 3-quarter investment cycle. But there just hasn't been. They've been patchwork kind of investments. So this whole migration to 100G is really like the big migration to 10 gig back about a decade ago. But yeah, so I mean, almost every company you can think about now needs the internet to sell products and goods and services. So you can't have the thing break.
Do you think there's kind of going to be a tipping point with things like, 4K and 5K video? These are things that they're kind of, you're starting to see them pop up at the trade shows and on tech blogs. But I mean, like the Verizons of the world and the Comcast, do you think those companies are really going to have to spend when that hits?
Well, I think it's more that they need to spend before. I mean, here's the funny thing. So probably a bunch of people on this webcast have probably tried to use Google Hangouts or Apple FaceTime or Skype, like Skype HD or Skype face-to-face. And I don't know about you guys, but every time I try to use something like that, the latency is pretty pronounced. And a lot of the pictures skip and the words skip, and sometimes you get knocked off. So I mean, we don't really even have an internet world right now where we can do a really good face-to-face broadcast and have it be crystal clear and look like you're watching the TV. I mean, so yeah, I mean, as customers demand higher quality of service for the things that they say they're paying for, the carriers are going to have to respond. By the way, 4G does make a big difference. So trying to do a FaceTime connection or a Google Hangout over 4G does work a lot better than over a 3G connection. But yeah, I mean, all these things are necessary ingredients. Gamers. I mean, if you're a big-time gamer, and I haven't been for I don't know 7 or 8 or 10 years, same thing. You want the fastest, that fastest internet connection possible, or your Halo character is going to get mowed over time and time again. So it's all these things. But yeah, I mean, any of the companies that are basically working from a big data standpoint with real-time data analytics, real-time sales analytics, they need this stuff, and time and speed does matter.
Okay, how does software-defined networking play into this? Because this isn't a field I know much about, but why don't you briefly describe that and tell us where they fit into this kind of big, global data glut?
Sure. So the best way to think about software-defined networking is sort of a Halloween scare story for the networking industry. But it could be out there. The whole point of software-defined networking is instead of buying a great big router that costs, I don't know, hundreds of thousands of dollars, you theoretically can patchwork. You can do stackable technology, so you can take a bunch of old PCs or old servers, use software to stack them, and then use software to basically connect those computers and use an array. And you basically run a software-defined networking system off of something like that. So you can literally, I mean, Google has kind of pioneered some of this stuff. You literally can take, 5 to 10-year-old gear, stack it together, connect it, and you kind of end up with this pretty powerful server. So the worry is that all the companies like Cisco, Juniper, and things like that could really, really be crimped if we have a big push into software-defined networking. An even easier way to think of software-defined networking would be to think about the migration from having all your data stored locally on servers and mainframes, and now we have cloud storage solutions, right? Like what VMware has helped pioneer. So there's sort of the networking version of cloud is software-defined networking. So I brought up VMware. If software-defined networking proves to be really disruptive to the big networkers, which I don't really think it will be, VMware is very well positioned. They've made 2 or 3 really good acquisitions in that area. There's not a whole lot of pure plays in the space. Cisco would tell you that they have a software-defined networking platform. So with Juniper, Ciena would basically say what they sell is basically leaps and bounds better than software-defined networking. So anyway, it's a new technology that could come around and prove to be disruptive to the traditional networking companies. And it's something I'm watching out for, and I'm trying to find investable themes in it. I do think it'll probably end up being a lot like the cloud. And as we're seeing, just because you have a cloud, just because you have cloud storage, it hasn't killed EMC and IBM. Those companies are still doing relatively well. But it could be a big growth industry down the road. And again, what I've written about and kind of what I've argued, whatever ends up happening with software-defined networking, chances are the companies that own the networking space now will probably end up owning software-defined networking. So VMware could be a threat, but if software-defined networking ends up taking off, my guess is Cisco and or Juniper will probably end up selling the best solutions for it.
Okay, excellent. So why don't we talk about wearables? Because you know, a lot of people are excited over Google Glass. You know, people are talking about an Apple iWatch, a possible Surface Watch from from Microsoft. I mean, who knows about that? But what do you think about this wearables market and where it's going?
I think wearables could be huge. So in fact, so the slide kind of connotes that we could see a long-running transition from smartphones to wearables. And again, I think it could happen. I think Google Glass is going to be a monstrous product category. If they can sell it at a cheap enough price point. You know, at $800, $900, $1,500, obviously we know the pricing is going to come down. But you know, can they get it down to $199, $299? That's really the question. If it's, I would say if it's anywhere close to $500, they're going to have a hard time selling massive volume. But you know, the watch wearable category could be good. I mean, here's the thing about watches, or I would say watches, armbands, or anything. What people will use these for isn't so much as a replacement for their smartphone, but a wearable device will probably be connected to a smartphone. And if you're into the workout craze, the fitness craze, or if you have some kind of health problem, I mean, I could imagine a combination of a wearable device and the healthcare industry could have a massive growth of product in that industry. So if you're a diabetic, right, and you have some kind of wearable technology, it could be measuring your blood sugar, reporting it to your smartphone or some device, and your doctor could receive updates of something like that. So in a future state world, the wearable industry just simply could be massive. And we'll see what happens. I think the first two products are going to be glasses and watches, and we'll kind of decide or see what they can come up with next. I mean, we all watch TV shows that aren't that futuristic, where somebody kind of has something in their ear. It's like a permanent ear implant. You know, that could be some kind of wearable device where, you know, you have a phone device that's basically, you know, like a hearing aid thing that sits in your ear. You know, it looks cool on TV. We'll see if something like that can, you know, can be effective in real life.
You know, it's funny. I was actually at a tech conference in New York a few weeks ago, and Siemens, they had a hearing aids which you could control with like a remote. Mm-hmm. So you could, I mean, you know, some people have difficulty adjusting their hearing aids. So it's interesting you brought up
That's right.
that medical point, because yeah, maybe we'll be 30 years from now we'll be controlling our bodies with our smartphones, or glasses or whatever, clicking and getting a shot of insulin or whatever it is.
No, that's exactly right. I mean, in my estimation, the single biggest product category for wearables will be a combination of a wearable device that has a medical benefit.
So I mean, do you think all these tech sites that are kind of focusing on like shooting videos and surveillance and things like that, they're kind of missing where these things really might end up? Because frankly, the medical angle never occurred to me.
Yeah, maybe. I mean, hey, when you've been around the world of technology long enough, you know that ultimately technology has to, for there to be a payoff, right? For there to be a return on investment payoff, the technology has to deliver value to somebody. So it's kind of fun to have like a Google Glass and shoot a lot of video and stuff like that, but all your friends kind of might think you're kind of creepy if they think you're just spying on them and shooting embarrassing videos to put on Facebook. So, you know, but again, I mean, I'm very clear on that. I think you could have a huge wearables market that's tied into medical intelligence, and in fact, I would be shocked if Apple doesn't end up with a really, really good product in this hybrid wearable medical device category.
Okay, excellent. And this is just a reminder to the audience, we have been getting all your questions and we are compiling them for a Q&A at the end, which will be in a few minutes. But if you have more questions, get them in and we'll try to answer them. Okay, so we're going to move on to, we touched on Google and Facebook and Microsoft. So why don't you just tell us what you think about Apple? I mean, do you think when are we getting a new iPhone, or do you think there's some product we're not expecting?
Yeah, so this Apple is, what didn't we say this was Voldemort on the last call we did or something like that? You know, the whole thing about Apple is it's gone from the most loved stock, and frankly, too much love, to the stock that's literally almost the most hated stock. I mean, if I were to look at Apple and look at the metrics that Apple has, and it had any other name in any other industry, it would still be a company that people would die for the amount of cash, the amount of patents, the amount of talent, the amount of future prospects that they have. So, I mean, in a nutshell, here's what I think is going to happen to Apple. I think, first of all, comps get a lot easier. They're not easy because Apple's done very well, but you're finally turning that corner where comps start getting a little bit easier. And any phone that is going to sell into China's largest network is going to be a huge incremental add for Apple. So, you know, that's called the EM phone or the cheap iPhone or something like that. Again, I'd be shocked if something like that doesn't come out and doesn't translate into very good China growth. The other thing is, I mean, you know, I've written quite a bit about the fact that, you know, I thought that and I love Apple products. I have about 3 or 4 of them in my home, but, you know, I wrote about the fact that I thought the iPhone was getting kind of stale. And I myself transferred to Android handsets a couple years ago. At this point, I think the Samsung phones are very stale. And I think the Samsung Galaxy S4, it won't be a bomb, it'll sell well, but it's basically sort of the most overhyped product, you know, of a tech product for a long time. So I think Apple has a very, very good chance if next iPhone, major one, 5S, 6, is at all good and innovative at all, I think it's going to sell really, really well. I mean, again, people aren't paying attention to what's there. Apple iOS 7 is a huge improvement. I mean, I look at stuff, I look at software at the root level, and the iOS 7 platform and iOS software is huge. The other thing is people forget Apple has yet to monetize what they have 500 to 700 million users. So either users of Apple products or iTunes users or subscribers, they haven't really begun to monetize that at all. So I think that's something they could do via payments or any kind of system that basically increases their subscriber growth. And the other thing that just happened, I mean, this wasn't even part of my thesis. I mean, we've had T-Mobile, Verizon, and AT&T all basically come out with a system where you can get 1 to 2 upgrades to the newest smartphone per year right now and basically not have to buy a new device. So, I mean, T-Mobile's plan looks brilliant. You pay an extra $10 a month and you get 2 upgrades a year. That's a no-brainer. I mean, if Verizon doesn't match that or AT&T doesn't match that, I'm going to switch over to T-Mobile. If you give me a chance to get 1 or 2 new iPhones a year for $10 a month, I mean, so again, everybody, and you and I, Mike, have been talking about, you know, an aging smartphone category and the decline in smartphone growth. I mean, this you know, frequent upgrade plan could actually really ignite or help maintain smartphone growth. So, I mean, I think Apple's pretty much ridiculous. Anything under 450. Are they going to have a great quarter coming up? Probably not. Their guidance could be kind of weak. But I'm actually in the process right now of totally reviewing my Apple model and my next price target. You know, and I was one of these guys that never joined the Apple 900, 1,000, 1,100 club. I kind of stayed at my 600 to 650 price target. But I'm now probably more bearish on Apple or more bullish on Apple than I've been since I was sort of a huge Apple bull like in 2009 and 2010. So it's again one of my top stocks and one of my top large cap tech stocks.
Okay, so thank you very much, Sean, for that discussion. We are going to move on to the Q&A. Now, we have a lot of questions in already, but again, if you have something, put it in there and we will do our best to get to it. So, okay, we will start with the first one. What do you think of the Motorola Moto X? Do you think it'll be a big hit?
Yeah, so part of my, you know, everybody kind of had Apple fatigue and iPhone fatigue. I think that now everybody has Samsung fatigue. I could be wrong, but years ago I envisioned an Android platform literally going from 3% to 70%. That's exactly what happened. Now I envision a Google-led Motorola absolutely crushing the Android space. Google helped all the companies basically, build Android phones. Google has never itself basically had its own company, i.e. Motorola, issue a Nexus product. Everybody loves pure Android. They hate Android bloatware. The Moto X Nexus is going to be a pure Android Nexus product. I think it's going to sell massively. So you maybe want to be cautious on Google now, but once we're 6 weeks away from the quarter ending where the Moto X starts selling, I'm going to be back pretty big in Google again. And I'm still pretty large in it, but I've divested of it a little bit this year. But yeah, I think basically it's going to be an Apple Motorola world for the next 18 months once the Moto X comes out. I think Samsung sales are going to be really disappointing. If LG doesn't get a Nexus phone, it's going to be in trouble. If HTC doesn't have a Nexus product, they're going to be in trouble. This Moto X and next couple iPhones could absolutely swamp the rest of the smartphone category.
Okay, great. All right, next question. Would you be short Baidu?
No, I'm long Baidu now. I used to hate Baidu. I guess that you don't really hate a company, but I basically believed it was very overvalued, and it was overvalued. It's sort of like I'd much rather be short Amazon right now, but I've been wrong on that a few times. But no, I'm long Baidu. In fact, I bought some Baidu again recently. I bought some in the low to mid 90s. I mean, Baidu's probably in a similar space to where Google was a couple years ago, where it sold off a lot, and over a 2-year period of time, a combination of earnings and revenue growth and a declining stock price basically made Google about 50% cheaper. And that's kind of what's happened to Baidu. A declining stock price combined with a year or two of pretty solid growth. Baidu today is literally 50% cheaper than it was 2 years ago. There's a lot of talk about competition for Baidu. Again, Baidu has a huge lead in China. And unless the China government lets Google back in, Baidu's got a huge advantage there. So I think Baidu could easily go to the 150, 120 area, and it could break to its former all-time highs.
Okay. Next question. So what have companies like Yelp, LinkedIn, and Zillow done right, and then companies like Facebook and Groupon done wrong? Which I would. I don't, let me reshape that. I guess within social media, do you think it's better, do you prefer the kind of specialty companies like Yelp and LinkedIn and Zillow over the more broader companies like Facebook?
Yeah, it's an interesting question. I mean, so let's just address Facebook because it's real quick. The only major thing Facebook did wrong is just basically overprice their IPO. Had they priced the IPO $7 to $9 cheaper, we'd probably all be talking about what a great stock Facebook has been, right? And it'd probably be at $45 right now. It'd probably be, or maybe 50. It'd probably be overvalued. So the single biggest mistake they did, but it was ultimately really good for the company, because the company ended up with a huge amount of cash, way more cash than had they priced that stock, 7 or 8 or 10 points lower. So that's really the only thing wrong Facebook has done. As far as LinkedIn's sort of a special situation. Yelp is sort of a special situation. I like Trulia. Trulia has been a really interesting stock. I've nailed that stock on a couple trades. So, again, Groupon, they're almost all, I don't know if you can say one versus, I mean, Groupon should have probably sold themselves to Google. Google offered to buy Groupon for $6 or $7 billion. So they probably should have just became part of Google instead of going public. But yeah, I don't know. I think a lot of it just what's the timing of the IPO? What do they price it at? By the way, Groupon is starting to come out and trade better. So we'll see over time. But I think the only thing wrong with Facebook is they just way overpriced the IPO. The specialty ones, we'll see what happens. I'm not a big fan of Yelp or LinkedIn at current prices. So we can end that one there.
Okay, all right, next question is, what do you think of Salesforce.com?
That's another one that's tough. I mean, every time I look at Salesforce now, I think it was a really good buy when it got crushed on their last earnings report, or it was a really good trade. I do think they have a really good defensible sort of base. They do a good job kind of keeping that moat around. Here's the best thing CRM does, and they do it just like Google. They buy up all the best technology in their space before it has a chance to come out and compete against them. So Salesforce is a really, really good investor in their space, and they're a good buyer of venture capital. And Google does that brilliantly too. That's one thing Apple should do a lot better of, by the way. But right here, if I were to look at Salesforce and compare them to 10 or 15 other names that you could buy, I'd probably find some names I like better. But if anytime that Salesforce gets whacked by 10 or 15 or 20%, I'd definitely take a look at it.
Okay. All right. Next question is, what are your favorite names in the small or mid-cap spaces?
It's just been so tough. I mean, I've done a really good job in tech large cap and even larger mid cap. Now, in the fiber optic space, those things kind of were nooses around my neck for about a year, and now they're coming on. So, I mean, again, you got to be careful buying anything that's up 50 to 100%, but I would still include anything in my fiber optic kind of 100G thesis as good small and mid cap names. So that's basically Ciena, Infinera, Finisar, JDS Uniphase. But I'd wait for a down day or a down 2 or 3 days to basically pick off at them, although JDS Uniphase is pretty cheap. There is an SDN networking play, CYNI, highly speculative, just came out as an IPO, but it's basically sort of the only pure software-defined networking play. There's a lot of chip companies that I do like. I continue to like Cavium. There again, the subscribers always see every time Cavium goes, basically in the high to the low 30s, I'd buy it. And almost every time I've done that, I've made 15 to 20%. So I always like Cavium on weakness. So there's a few. I mean, the best way. I mean, some of these things kind of come to me at special situation or a price point, or on an earnings miss or something like that. So I would look to try to grab those kind of names on weakness.
Okay, all right. Thank you, Sean. Next question is...
People can follow up and send questions in, and I can redisseminate some names in that category too. This is for kind of a future bonus.
Okay, so the next question is, do you prefer Qualcomm or Intel?
Well, I'm laughing because I don't know. I've written so much about favoring Qualcomm.
Oh, I got a gun in your head. You got to pick one.
I do like Qualcomm.
Oh, okay.
But I do like Intel. I think Intel's probably going. Oh, go ahead.
Okay, so you know what? Why don't we talked about Intel before? So why don't we move on, because we have a lot of questions, and
sure.
I think let's try to get to them. So, do you have any thoughts on Giant Interactive? FYI for the people out there, that's ticker GA.
Yeah, no, I know Giant. That's one I probably don't know well enough right now. I used to be better at the gaming stocks. I guess my attitude on the gaming stocks right now is that field is tougher. I do like Electronic Arts, and I've had some decent success with that name, although maybe not as good as I should have had. But I'm not close enough. I haven't given that one a kind of a close enough look for a while. But I can definitely say that EA looks interesting, and I'd be a buyer of EA on weakness myself.
Okay. Now, what about the two beaten down names in mobile, BlackBerry and Nokia? What do you think of those two?
I don't really like Nokia. BlackBerry was a huge winner for me in the first part of the year. I smartly sold like half of it, or maybe a little more. I nibbled a little. I carried some into the last quarter, into disaster. I mean, again, BlackBerry needs to do one of two things. They either need to they need to make they need to make an Android handset and sell it along with their own. And that's an easy, and I'd be happy for anybody at BlackBerry to contract with me. I could tell them exactly how to do that strategy and make a lot of money. And they need to basically, put the company up for sale. I do think it's got $3 billion in cash, and I think the patents are worth $2 or $3 billion. So basically, the handset division of BlackBerry is being assigned no value. I think the stock is worth 14 to 18 bucks, and we'll see what happens. But that last quarter kind of scared me, to be honest with you.
Okay, next question is with Dell, and FYI for people out there, Dell may be about to be acquired by Michael Dell and Silver Lake or Carl Icahn. So what do you think of Dell here at 1288?
I don't think there's a trade because I just don't think there's much of a trade because I think most of the upside is already in it, unless the icon bid ends up being for a lot more. So yeah, I just don't think that's a trade because the good prices were what 3 to 6 months ago.
Okay. Any updated thoughts on 3D printing?
Yeah, it's like the sector that got away. It keeps going. I think we had a question on 3D printing. I mean, again, if you're in the names, congrats, because you've had the courage to stay in them. I would have trailing stops on them. They're really hot. They're probably due to get some piece of bad news that's going to adversely affect them. I would have a hard time, and I'm not buying any of the 3D printing stocks right here. But man, they have been monsters, and they've done really well. There is still a gem in the space, which is called Autodesk, which has done nothing. But if the space really keeps doing what, in other words, if 3D printing goes from these 3D printing makers into providing software to help make the designs that the 3D printing machines make, and it goes from a hardware to a software-based model, Autodesk is going to crush it. But they have yet to sort of show sort of the momentum from 3D printing. But that's the only name that I think is sort of cheap. So again, I use trailing stops, and they may keep going higher.
Okay, and we are down to our final question. Unless if anybody wants to get one in now, we'll sneak you in. But final question is, what do you think of NVIDIA?
NVIDIA is it's a deep value stock. It could do well. I kind of like the name off and on. I tend, if any time it gets crushed, I tend to buy it through a trade. Right here, I'm a little worried that their technology or the traction that they're getting on their mobile side isn't better. But again, they've got a huge amount of cash. They're going to survive. They're going to be fine. I still think Intel should buy NVIDIA. Or somebody else should buy NVIDIA. And so here's the funny thing: if you're willing to have the patience to own a small chunk of NVIDIA, you're probably gonna get paid at some point. In the meantime, it's very boring watching it because it doesn't move much. It doesn't provide a lot of trading opportunities. But that's kind of what I do. I own a relatively small position, and I might wake up and the stock might be 80 to 100% higher. And to be honest, that's really the only reason that I own it.
Okay, and we just got one more in. What do you think of Concur Tech? Ticker is CNQR.
Concur is, again, it's a name that I used to follow more when it was cheaper. The stock is very expensive right now or it's expensive on a valuation basis. The chart looks pretty parabolic. Again, hot stocks, you get hotter in this kind of a market, but that would be a name that I myself am not involved in it. I would have a hard time putting fresh money into it, but it's been a nice winner, and in that particular space, I do like that name better than some of their competitors. But yeah, I mean, it's one of these many tech names that you kind of wish you would own, and you can't own them all. That's an expression I like to write. You just can't own them all.
Okay, and folks, that is going to wrap it up. As a reminder, we will send you an email to a replay if you'd like a copy of the presentation. You can email us, follow Sean on Twitter at Udall TechStrat. And Sean, once again, thank you very much for your time. I'm sure everybody found it very helpful.
Thank you. Have a great day.
All right, thanks, Sean.
See you, everybody.